For the last 3 years, rent across America did the unthinkable. It skyrocketed faster than any time in modern history. But in 2025, everything changed, ushering in a period of unprecedented market correction. If you're a renter, landlord, investor, or economist, understanding this shift is crucial. By the end of this analysis, you'll grasp the complex forces at play and what they mean for your financial future. For years, landlords seemed to hold all the cards. They confidently raised rents by hundreds overnight, operating under the assumption that demand would always outstrip supply. This era saw tenants scrambling, often paying exorbitant prices just to secure housing. However, the economic landscape has dramatically altered this dynamic. The perceived invincibility of the rental market has now collapsed. This isn't just a minor adjustment, it's a fundamental rebalancing of power. The market, once heavily skewed towards property owners, is now showing signs of significant tenant leverage. Jason moved to Austin in 2021, drawn by the booming tech sector and promising career opportunities. He secured an IT role, and while rent was already climbing, it seemed manageable within his budget. However, the relentless increases soon became unsustainable. By 2023, his rent surged from $1,400 to $1,900 in a single year, a staggering 35% jump. Jason found himself trapped in a cycle where his entire paycheck was consumed by housing costs. "I was working just to pay rent," Jason recounts. "There was nothing left for savings or even basic necessities." His experience mirrored that of millions, highlighting the severe affordability crisis that gripped the nation. What many landlords and investors didn't foresee was the impending market saturation. Across the country, cities that once boasted fierce bidding wars are now grappling with a surplus of vacant units. For the first time in over a decade, average rents are not just stabilizing but actively falling, and at an alarming rate. This downturn is a direct consequence of aggressive development and speculative investment. Developers, fueled by cheap capital and seemingly endless demand, overbuilt luxury units. Investors, chasing high returns, borrowed heavily, betting on perpetual rent growth. Meanwhile, renters, pushed to their financial limits, finally reached a breaking point, leading to a significant demand contraction. Austin's meteoric rise as a tech hub was legendary, attracting massive corporate relocations and a high-earning workforce. Between 2020 and 2023, its skyline transformed with new luxury apartments, and landlords capitalized on the intense demand. The city became a symbol of unchecked growth and soaring rental prices. Then, the market broke. Average rent in Austin is now down a staggering 14% year over year, marking the steepest decline in the entire Sunbelt region. Thousands of newly constructed glossy apartments now sit half-empty, their once vibrant rooftop pools echoing with silence. Developers who once boasted about extensive waiting lists are now resorting to desperate incentives, offering 3 months of free rent, waiving security deposits, and even providing concert tickets to attract tenants. The primary catalyst for this reversal was the tech sector's slowdown. Significant layoffs from major companies like Meta, Oracle, and Tesla decimated Austin's high-income renter base. For renters like Jason, this shift brought unexpected relief. "I actually got a text from my landlord offering to lower my rent," he laughs. "After 2 years of relentless increases, it felt surreal." This illustrates a critical economic principle. Oversupply, coupled with reduced purchasing power, inevitably leads to price adjustments. Phoenix was another poster child for rapid growth, attracting thousands of families and investors from California and the Midwest. Entire new suburbs in Chandler, Glendale, and Mesa sprang up almost overnight, with developers struggling to keep pace with demand. The optimism surrounding Phoenix's real estate market seemed boundless. However, by 2025, that unbridled optimism melted into a severe oversupply crisis. More than 30,000 new rental units flooded the market in just 12 months, far exceeding the actual demand. Average rent in Phoenix plunged by 12%, forcing landlords to offer unprecedented concessions. These incentives include free months of rent, fully furnished move-ins, and even prepaid utilities. Apartment complexes that once maintained long waiting lists are now actively begging for occupants. While the city's skyline continues to expand, its rental market is financially strained. This situation highlights the precarious position of Phoenix landlords who over-leveraged, now facing significant financial pain. Dallas, with its robust corporate relocation scene and influx of young professionals, once appeared invincible. The city's growth, particularly in areas like Uptown, seemed limitless, fueled by continuous demand. However, in 2025, that unwavering confidence began to crack under economic pressure. Rents in Dallas dropped by 10%, and Class A vacancies are now at their highest level in a decade. Between 2021 and 2024, developers added tens of thousands of new units, while renters simultaneously began tightening their budgets. This created a perfect storm of increased supply and decreased effective demand. Persistent inflation significantly eroded disposable income, and stubbornly high interest rates further constrained household budgets. Landlords are now scrambling, offering free utilities, covered parking, and substantial rent credits to attract and retain tenants. Investors who relied on consistent cash flow are finding themselves in the red, facing negative returns and difficult decisions. This market correction is not isolated to a few hotspots. It's a widespread national phenomenon. From Miami's significant 11% decline to Seattle's 10% drop, and from San Francisco's historic 15% collapse to New York's shocking 12-15% plunge, the narrative remains consistent. This indicates a systemic issue rather than localized anomalies. Economists are observing a broad recalibration across major metropolitan areas. The rapid expansion of rental supply, coupled with a contraction in effective demand, has created a buyer's, or rather renter's, market. This national pattern underscores the interconnectedness of regional economies and the ripple effects of macroeconomic shifts. The current rental market downturn is not attributable to a single cause, but rather a confluence of powerful economic forces. It's a perfect storm that has reshaped housing dynamics across the country. Understanding these factors is crucial for anyone involved in real estate or financial planning. The tech sector, a primary driver of rental demand in many booming cities, experienced significant layoffs from giants like Amazon, Meta, and Microsoft. Thousands of high-earning renters who could afford premium prices suddenly evaporated from the market. Furthermore, the remote work wave, which initially fueled migration to these cities, has receded, reducing the need for urban living for many professionals. This directly impacted the demand for luxury apartments, leading to increased vacancies and downward pressure on rents. Persistent inflation has relentlessly eroded the purchasing power of average households. While the cost of living soared, wage growth largely stagnated for many, creating a severe affordability crisis. Renters, facing squeezed budgets, have been forced to make difficult choices, doubling up with roommates, moving back in with family, or relocating to more affordable, often suburban or exurban areas. This widespread financial strain significantly reduced the pool of eligible renters for higher-priced units. During the boom years, developers, driven by optimistic projections and readily available capital, embarked on an aggressive building spree, particularly in the luxury apartment segment. They bet heavily on endless growth and sustained demand. However, this proved to be a significant miscalculation. Many projects now sit half-finished or completely abandoned, contributing to a massive oversupply. This glut of inventory, especially in the high-end market, has created intense competition among landlords, forcing them to lower prices and offer concessions. Landlords themselves are facing immense financial pressure from escalating operational costs. Insurance premiums have tripled in some cities, significantly increasing overheads. Homeowners Association (HOA) fees have skyrocketed, and property taxes have soared in line with previous market valuations. These rising expenses are squeezing landlord profitability, making it difficult to maintain properties and cover mortgage payments, especially for those who purchased at peak prices or are highly leveraged. This pressure contributes to the urgency for landlords to fill vacancies, even at reduced rates. After years of financial struggle, Jason finally caught a much-needed break. His rent dropped, and he successfully negotiated more flexible lease terms. For the first time since 2021, he's actually able to save money, a stark contrast to his previous situation. "My friends are still paying what they were in 2023, he notes, but the market finally shifted. It caught up to reality. However, this isn't a universal win. While renters like Jason find relief, landlords who over-leveraged are now trapped in difficult financial positions. Investors who bought properties at the peak of the market are underwater, facing negative equity and cash flow challenges. The psychological shift in the market is as significant as the numerical changes, impacting confidence and future investment decisions. For the first time in over a decade, tenants possess significant leverage in the rental market. They are no longer passively accepting unfavorable terms. Instead, they are actively walking away from bad deals and demanding better conditions. This newfound power dynamic has fundamentally flipped the script. Luxury apartments that once commanded $4,000 a month now sit empty, even at $3,000 with added incentives. Downtown buildings that previously maintained extensive waiting lists are now offering substantial cash bonuses just to attract new occupants. This shift forces landlords and real estate agents to adapt their strategies, focusing on retention and competitive pricing rather than simply raising rents. Whether you reside in Phoenix, Austin, Dallas, Miami, or New York, the same underlying patterns are unfolding. The era characterized by fierce bidding wars, blind applications, and relentless rent hikes is definitively coming to an end. This isn't merely a temporary price correction. It represents a profound cultural and economic shift. Millions of Americans are now questioning the fundamental sustainability of the rental market. In an economy where costs consistently outpace wage growth, developers prioritize luxury, while renters desperately needed affordability. Investors chased speculative returns while families sought stability. The reckoning has now arrived, forcing a re-evaluation of housing priorities and market practices. Housing markets, despite their perceived resilience, do not defy economic gravity indefinitely. While some cities may eventually recover and resume growth, others might experience prolonged stagnation or even contraction. The overarching lesson, however, remains consistent across all regions. If you are a landlord or investor who over-leveraged, if you relied on endless rent increases, or if you ignored the clear warning signs of market saturation, 2025 serves as a critical wake-up call. For renters like Jason, this period offers much-needed breathing room and improved affordability. For landlords and investors, it's a stark imperative. Adapt your strategies, adjust your expectations, or face the difficult decision to exit the market. Are you experiencing these dramatic shifts in your city right now? Whether rents are falling in your market, or you're a landlord feeling the intense pressure of vacancies and rising costs, your perspective is invaluable. Share your story and how this rental market transformation is affecting you in the comments below. If this comprehensive analysis has opened your eyes to the profound changes occurring in America's housing market, please hit subscribe and turn on notifications. What's happening right now isn't a temporary blip. It's a fundamental transformational shift that will redefine real estate for years to come. Stay informed, stay prepared, and let the numbers tell the story.